Welcome to the Official's quarterly volumes review, where this quarter volumes fell quiet. At 232 billion barrels, Q3 was the lowest since 2024 and down almost 25% quarter on quarter. But open interest was little changed and was actually higher than we projected in our Q2 report. The markets were fatigued to headlines, with a clear example being Trump. Markets remained reactive in H1, but by Q3, Truth Social posts garnered little reaction. Markets stopped trading headlines and turned to a structural supply excess thesis, the superglut. But in Dubai, volumes spiked, partly thanks to a big physical play throughout September. Well, hello and welcome to a really special edition of The Officials. I'm your host, Lisa Aziz, and joining me today in the Flux News studio, I'm delighted to say are our leading officials, Ed Hayden-Briffett, Will Cunliffe and Spiros Kokkas. Hello, guys.
Hello.
Good to see you. Now, usually, as you know by now, we would focus much more on the current state of the physical and derivatives oil market. But in this session, we are going to take a much deeper dive into a piece of work the officials have just completed. It is their quarterly traded volumes review, and they are going to tell us all about it right now. Can't wait to hear about it. First things first, though, for the benefit of everybody tuning in, what drove the decision to create this review? What factors? Why is it needed?
Yeah, I mean, it started the process maybe 9 months ago. So this is our second edition. We produced our first edition for Q2, so released in Q3. The reasons for producing it, I mean, we were, for our own use as market reporters, but also on the research side, looking at the COT data, we really wanted to understand a little bit more what drives liquidity. How does broader market liquidity evolve, and where do we expect it to go in the years ahead? And that's important for a number of reasons, but primarily it's critical to understand how easily someone can get in and then get out of a position. If the liquidity conditions are very poor, that's when you often see people struggling to get out of positions. And on the converse, if liquidity is really good, that can often be conducive of more risk appetite, often larger position taking and more speculation. So it kind of came from a problem that we had and that we looked to then solve. And we kind of did a survey of the kind of broader market offering and really found very little in the way of volumes forecast, open interest forecast. It seems as if really there was not that out there. So we took it upon ourselves to have a crack ourselves.
Good niche.
Yeah. And hopefully it's of use to the broader market as well.
Thank you for setting that out. Just now, though, tell us a little bit more about the target audience you want to reach, why they need to read it. What will they learn? Ed?
Well, like Will said, it basically comes down to liquidity conditions. So the target audience is anyone in the market who would have an interest in current liquidity conditions and expectations of future conditions. So that can be market makers, exchanges themselves, hedge funds, anyone trying to trade, risk managers as well. So basically anybody who has this kind of vested interest in how conditions are now, how they will be in the future. And I think it will kind of give them an idea of what to expect and how they can approach these challenges with a bit more kind of clarity, because as Will said, there isn't really a great offering out there in the market for this kind of forward guidance.
Well, I think you've just delivered it. So sum it up for us then. What's the headline takeaway from this quarter, Spiros?
I mean, obviously, the main thing of Q3 was headline fatigue. So the markets looked very unresponsive to recent developments that were happening, especially as Will's gonna explain later with Trump's news and his Truth Social specifically. And we saw that in Q3, surprisingly enough, we recorded the volumes to be 232 billion, which is over 70 billion barrels less compared to Q2. So this was a very large drop. While open interest was held broadly flat, relatively unchanged, so 0.05% down on the quarter. So that means that obviously risk appetite was there, but the amount of volumes traded in Q3 pointed to a regime change in our view. However, if we were to look at our forecast going forward for 2026 and 2027, we forecast volumes to grow by about 11% to 1.18 trillion barrels for 26, and for 27 we expect this upward trend to even accelerate further, about 16.8% year-on-year growth compared to 26, so approximately 1.38 trillion barrels. Open interest, on the other hand, is expected to rise somewhat mildly compared to volumes by 8.2% in 2026 and 7.1% in 2027.
Thank you. Okay, just take us through this report in a little more detail now then. The impact particularly of President Trump's comments on his Truth Social platform. You know, those comments can have such an impact on the market, can't they? We've all seen the sudden highs and lows, the sheer volatility suddenly created from comments like this.
The United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating.
Well, goodness, there must have been audible gasps on your desks and certainly over the road on the trading floor when comments like that come in.
Yeah, I mean, completely. I think no one would argue that Trump has had a pretty profound impact on markets ever since he came into office. I mean, just looking at the chart here, which is figure 3 from our quarterly review, this is the price action in Brent front month following, or just surrounding, a Truth Social post, based on the fact that Russia is absolutely pounding Ukraine right now, blowing up everything in sight, including civilian targets. It is very hard for anyone to believe that Biden's policies, decisions and actions have made the world safer, and goes on to talk more about leadership. And you can see there's a pretty aggressive move up in flat price there. We rally about 40 to 50 cents just on the immediate onset of the truth being posted, and then continue to extend that rally throughout the rest of the window on display. And I think this was a consistent theme. You know, we had a market that was very sensitive to any news coming out of Trump's Truth Socials or coming out of the White House more broadly. That sensitivity has considerably reduced over time. And I think that's been something the market has been very conscious of. You know, throughout Q3 trading, a constant theme was market fatigue. This idea that, well, if Trump has just posted this today, he's going to probably post the opposite tomorrow. So why would I take any risk and take any position on that? And that is something that is even obvious when you just look at his social media engagement. As you can see in table 1 here, we have dissected our database of Truth Social posts by quarter. In quarter 1, we had 1,584 posts, average reshares 4,000, average likes 18,000, and average replies just over 1,000. But you can see that those metrics drop off very, very quickly, and almost halved by Q2, and then continue to decline into Q3. So even his social media followers are losing interest in what he has to say.
I find that extraordinary. It's almost like everybody cottoned on to him pretty quick, actually.
Yeah, well, it's the classic. It's the Trump taco. It's Trump always chickens out. He constantly flips back and forth between today it's yes, tomorrow it's no. So the problem with this is then, how do we quantify that? How can we measure this attenuation in reactivity in the markets? Our response to this was, okay, so let's make a sentiment index. So you can construct sentiment index in a number of different ways. But the problem becomes, if you're making the index based off of market measures, then you internalize that fatigue in your measure, so you'll never be able to identify it. So our kind of solution to that was, we use what's called a Roberta model, which is a language text-based machine learning model. And we trained the coefficients of that model on Q1 and Q2, looking at the high frequency pricing response to Trump's Truth Social posts, to the rhetoric and the textual content of those posts, at a very high frequency, and encoding a metric with those coefficients. So then that basically assumes in your measurement that the market is not fatigued. And we can see that on figure 5 here, the Trump impact factor, we call it. And that's stationary. So that's what we really want to see. We don't want to see this metric declining into Q3. And the idea here is to then regress this on volumes. So that's what we did, and we used a process called vector autoregression. We cleaned a lot of the volumes data by extracting cyclical patterns. So, for example, you always get EIA stats on a Wednesday. You typically have higher volume on a Monday and a Friday as people try and get in quickly or get out of positions quickly. And we then also controlled for kind of broader structural shifts in open interest. So this is really that really sensitive portion of volume variation that could be explained by something like a headline coming from Trump. And we can see in the impulse response function here that changes in volumes, they're pretty responsive in Q1. So we have a positive mean there, and that decays over the IRF horizon. And that's what we would expect if the market is sensitive. Q2, that's even more pronounced. So we're seeing a big uptick in the change in volumes contemporaneously with that realization of the Trump Truth Social post. But then in Q3, we see no response. So here, volumes are basically unresponsive, even though that metric is encoded as a pre-fatigue metric. So this means that in our opinion, this is a direct result of headline fatigue. The market is not reacting. And that has been one clear driver, I think, of the muted trading intensity that we've seen through Q3. Traders aren't as motivated to get in and get out as quickly.
So far then, we've seen traded volumes were down significantly in Q3 by 10% from Q3 last year. The intensity of trading fell as money managers took longer-term positions rather than headline trading, and market responsiveness to Trump's Truth Social posts fell hard to indifference. Were you at all genuinely shocked at those charts and what emerged?
I mean, definitely when we were observing the participation of the players and the volatility in the environment over Q3, we were quite shocked when we were looking at the changes in flat price, at least, which we're monitoring on a minutes basis, that the market wasn't moving as strongly as it was in Q2. So I think that was the initial, essentially, thing that we wanted to test mathematically and we see if we could prove it. So that's how the idea started.
Right. So which players in particular then have seen a change in behaviour, certainly this quarter? What did you find was the driver of that development?
Well, we want to officially test at the beginning what was the behavior of the speculative players in the market. And I think we have to give some context to what happened over Q3. So we had all these big agencies and investment banks calling for massive surpluses, obviously in 2025, but heading to 2026, which we, the officials, obviously do not disagree because Onyx Capital Group was one of the first balances to prove that we're forecasting surpluses in the market. But the IEA, for example, is now forecasting an almost 5 million barrel per day build heading to 2026. So obviously players, market participants and money managers specifically, when there's little to no volatility in the front tenors, and obviously listening to these agencies projecting these surpluses, one of the main trading ideas would be to trade the deck spread, basically capitalize on the change in the backwardation or contango, specifically the strength of the spread over those two tenors. And obviously, what we see in figure 4 here in this waterfall chart is that the first 5 tenors have declined pretty significantly in terms of the average volumes traded between Q3 and the first half of the year. Whereas the tenors, as we can see here on the green, they are around the December 26 tenor, and obviously the more deferred ones around the December 27 tenor have also shown either little to no change or some positive change of compared to the first half of the year. So that's in our view that first of all points out to some clear regime change and clear change in, maybe we could classify that as reallocation of the money placed from money managers. So we wanted to officially test that. So we start initially by looking at trading intensity. So we call trading intensity this measure here, which is essentially volumes divided by open interest. And the reason why we don't look at volume specifically is because we want to understand how many barrels are traded with respect over a certain amount of market risk held currently by players. And we can see here big swings in the market. Obviously, Liberation Day was a big spike. The 12-day war was another big spike. And in Q3, the market has pretty much hasn't changed that much, as we can see here. It seems very quiet. So we move in Q3 under a lower mean and standard deviation compared to the first half of the year. And then when we looked at the money manager section, we can see here the swings. This is to be specific, this is the aggregate money manager Brent open interest. So we're interested more specifically on the aggregate open interest rather than the direction, whether they're net long or short, because we want to understand how much open interest or how much swing in their positions are being week on week. So here, as we can see, first half of the year, we see huge variability, 20% drops, 10% increases. So this means that the money managers are exiting and entering their positions quite frequently, which is something that we didn't see in Q3. So then we went forward to test this mathematically, and obviously initially we regressed understanding with the prompt Brent futures. And we chose this analysis because obviously prompt Brent futures represent about 10% of the global traded volumes, not only for Brent but for all products. So it's a very liquid market, especially the front tenor. And we wanted to understand the relationship to that. So Brent, obviously, unsurprisingly enough, shows that if volatility is less in the weekly changes of Brent flat price, trading intensity would naturally decline. And then we test a second stage regression, which is the residual, where we try to capture basically how much of the change in the Brent, in the weekly Brent price is not reflected in our regression. So then that's where we put the money manager trading intensity, where we look at the weekly changes. And our regression showed that Q3 was actually a strongly statistically significant regime change, which showed the money managers, the trading intensity actually dropped. That was proven mathematically. And we could attribute that not necessarily to money managers, but as a clear change in the speculative positions overall in the market, where we showed obviously in the waterfall chart that the most front tenors declined in volumes, whereas the more deferred ones increased. So that clearly showed a reallocation of the capital, where they wanted to invest in more long tenors and in a set and hold basis rather than a short-term trading, where we saw that quite aggressively in Q2 around the war and the Liberation Day on April.
That decrease then in traded volumes, was it, a global trend, or were there any examples absolutely going against the grain?
Well, we typically in these studies, we like to do a case study as well. So last time in Q2, we did a case study on Mervyn because that was kind of the grade and the contract of note in Q2. And this time we decided to do buy swaps. So while we saw that the overall market had declined significantly, like we said, 25% or so in terms of traded volumes quarter on quarter, Dubai was down in terms of Dubai swaps by 8%. So there's quite a significant disconnection between the decrease in Dubai swaps traded volumes and the overall market. The question has to be therefore why? Because in July and August, we did see a significant drop in Dubai swap traded volumes to between 1.4 and 1.5 billion barrels each of those months. So that's quite a big drop compared to where we were in the previous quarter. But September was where things became really interesting, because this is where, particularly so far, we've talked about the derivatives market. This is where it links back to the physical, because in September, we had this kind of culmination of a massive physical play in the spot market. So Mercuria particularly had accumulated a lot of Dubai grade cargoes. So particularly Upper Zakum, they had something like 30 Upper Zakum cargoes they'd accumulated in the lead up to September trading. And they sold those pretty aggressively in the window. So we saw record breaking physical trading in the spot market in Dubai, 49 cargoes declared. I think 45 of them were from Mercuria, 4 from anyone else. So it was really dominated by this one player. And we saw at that time as well a massive increase in swaps volumes. So from the average of July and August, September traded volumes in Dubai swaps were 31% up. And that's really because this kind of the impetus of the physical play had on the derivatives market demonstrates that you've got this quite strong connection really between both the physical spot market and the derivatives. And also in September, we had very weak volumes compared to previous months. Like in the rest of the quarter, they were pretty low, whereas in Dubai, much, much stronger. So Dubai has really kind of stood apart from the rest of the market in September, particularly. July and August, not so much, but we saw 36% above the July and August average. So it's a huge change month on month for September, and demonstrates really the increasing importance of Dubai as a benchmark, because once it's able to stand alone and independently from the rest of the market, not just follow the trend of the overall decline in the market, but also stand on its own 2 feet as an independent benchmark that isn't just influenced by the overall move in market trends, it becomes much more important. And in the time horizon that we're looking at for this data, so since January 2015 until now, we've seen Dubai volumes as a percentage of global traded volumes are more than 10 times larger as a share. So this is becoming an increasingly important benchmark. And it's really, I think, partly because of the vulnerabilities of Brent and WTI as benchmarks to whether it's low liquidity issues in the physical side or US policy with WTI. Dubai, as well as being a massive benchmark in terms of what it's used to price, like OPEC grades, for example, coming out of the Arab Gulf is like nearly 30% of global supply. So, and as a medium sour grade as well. So naturally, it's more useful for benchmarking that type of oil. So I think that this quarter, Dubai has really demonstrated why it can become one of the most important benchmarks in the market. And this case study is intended to demonstrate why it's really matured as it has. And, you can see the trajectory since 2022. We saw particularly then with the advent of screen trading on ICE, particularly, there was a big increase from early 2023 onwards. And that has really accelerated this year as well in the first half. And also then we've seen the strength in September and October as well.
The market fatigue in Q3 was clear, and it's no surprise that volumes fell even as open interest stayed unusually high, a sign that participants were more comfortable holding longer-term risk. Looking ahead, our forecast points to a rebound. Volumes are expected to rise by more than 12% in Q4, even with the lower volatility we currently observe, while open interest is set to grow by another 2.6%. Ed, Spiros, Will, what a serious, thoughtful piece of work we look forward to the next review. Thank you very much.
Thank you.
Thank you.
I hope you enjoyed our very special edition, and remember, you can get much more information on this new report on our website at flux.live, on Flux Freemium, and via the QR code on your screen. Bye for now.